When you buy a property, you'd assume the value of the property is the price that you paid for it.
But that's not always the case, at least in the eyes of the banks.
Congratulations, you played yourself.
When you're getting a mortgage for a property, the banks will do a separate valuation to make sure the price you're paying for the property is what the property is really worth.
They do this because they want to know how much they'll be able to sell your property in the event that you default on your loan, and they have to repossess your house and sell it to cover the cost of a mortgage.
And sometimes when the bank values your property, it'll come back at a price that's lower than what you paid for, sometimes much lower.
You lose! Good day, sir!
If it happens to you, then it can put you in a bit of a tricky situation financially, especially if you bought the property at an auction or you've signed a contract unconditionally. With market conditions as they are today, we've been seeing this issue more frequently.
Yeah, for example, we had some clients that went to an auction unsuccessfully at a house in Windsor on the weekend. It sold for $1.220 million. This is way more than what they're expecting. But as you can see from this valuation report, the estimate of the house was only at $805,000, more than $400,000 lower than the price it eventually sold for. In this case, the bank would have definitely sent someone out to do an in-person valuation rather than rely on the automated one. But even so, if I'd bought this property, I'd be pretty concerned about the valuation coming in low too. And unfortunately, since it was an auction, if the valuation does come in low, then the people who bought it could be in trouble.
In today's video, we're going to teach you everything you need to know about property valuations so this doesn't happen to you. Specifically, we're going to cover the two different types of property values and why it's important to know the differences between them, how banks value property, including the different types of valuations they might use, why bank valuations often come in lower than the purchase price or market value, the potential impact of a low valuation, including exactly how much it could cost you, and finally, what to do if you get a valuation that comes in low. And the good news is you might be able to fix it. Before we start this video, if you find it helpful in any way, do me a little favor and hit that like button or leave a comment below for the YouTube algorithm. Just a little gesture like that can make a huge difference to the channel. And if you haven't already, hit that subscribe button below. Thanks you guys, it really means a lot. So let's dive in. So what are the two different types of property values?
Yeah, first there's market value. This is almost looking at what the property is worth today or what people think it's going to be worth. It's the kind of value that you might be familiar with. Simply put, market value is the price that the property will sell for on the open market. But market value doesn't always reflect the true value, even the replacement of the property, at least not in the eyes of the banks and lenders. Market value always includes a bit of an element of emotion and sometimes ego that can drive the price higher than it's actually worth. And this is especially true with auctions. I guess like you saw in that Blackmore Street example, buyers can get easily carried away with the competitive environment and end up paying much more than what they budgeted for in the quest to win the property. And if they're falling in love with the property and don't want to miss out, they're always willing to extend themselves even more.
And the market value can also get inflated when the market is hot, like it is now. Buyers get FOMO and end up paying too much because they don't want to miss out.
Yeah, we saw this recently with some clients that bought in Petrie in Brisbane. There were hundreds of people that had been to the opens and there were 30 written offers made for this property. Our client's offer was in the top 5 of the 30 offers. So 25 people got a text message back from the agent saying bad luck, and 5 people got the last chance to up their offer and make their last and final to try and secure the property. Our clients ended up securing it for $770,000. They didn't want to miss out. They'd been to a bunch of auctions. They'd missed out on 5 properties in the last 3 months and were sick of it. Unfortunately, the bank didn't agree with their market value of $770,000. The bank didn't really factor in the 30 other offers, the missed properties, the fatigue of being sick of the hunt and potentially being gazumped on the last property. And unfortunately, in this case, the bank ended up valuing the property at $700,000. Now in our client's case, they had a pretty big deposit and were able to make the difference and proceed. But in a lot of other cases, if you're a first home buyer and you don't have that extra savings, you can be in a lot of trouble.
I guess the key takeaway here is that sometimes the market value is higher than the actual valuation of the property that the bank's willing to support. And it's mainly caused by the emotional aspect of the property purchase in the process.
And now the second type of property value is the bank value. At some stage during the loan application process, the bank will do an independent valuation of the home you're willing to buy.
They do this because they use the property as a security for the loan. In other words, if you default on your loan, the lender has the right to sell the property to recover the outstanding monies owed.
You have my money, right? Yeah, It's coming.
So realistically, the bank wants to make sure that the value of the property is high enough to cover their potential losses if they need to repossess the property and sell it on the market.
Unlike the market value, the bank value doesn't take emotion into account. It's purely a numbers game. There are 6 different types of valuations that the banks can use. Contract of sale. This is referred to as a contract of a sale assessment. This type of valuation assessment only relates to the purchase transaction, and its application is restricted to certain types of properties and locations. This assessment has no value input whatsoever. They just adopt the purchase price on the contract of sale.
In that assessment, generally you have to have a pretty big deposit for the bank just to accept the contract of sale. They run it through their system. The computer literally says, yes, we're happy to accept the contract of sale, what you paid, and they go ahead. More and more often at the moment, it's pretty rare for the banks to accept a contract of sale assessment.
The next is an AVM. AVM is short for Automated Valuation Modeling. An AVM is a computer-generated estimate on the value of the property. They look at the attributes like the number of bedrooms, the land size, along with comparable sales in the area. These come with a confidence score, which is an estimate of the level of accuracy on the estimate.
At the moment, AVMs can be pretty hit and miss, especially if the property is never sold before, it doesn't really have an anchoring point, it doesn't factor in if there's been renovations, even sales that have happened in the last 1, 2, 3 months. Sometimes there's a bit of a lag and a bit of a delay there, and the AVMs aren't factoring in the current market value.
Desktop estimates. These are sometimes referred to as electronic valuations.
Desktop estimates are produced by a licensed valuer. The valuer will reference the property attributes, comparable sales, and photographic evidence of the property in order to arrive at their estimated value. They don't do a physical inspection. Basically, a desktop estimate's like an AVM with a person individually curating the sales and picking them out rather than the computer doing it.
Curbside assessments. These are also known as drive-bys. A licensed valuer will externally inspect the property and use their assessment along with the comparable sales to estimate the value of the property. This estimate is given as a value rather than a single figure.
Short form valuation. This is probably the most common type of valuation assessment. It relies on a licensed valuer carrying out an internal and external inspection of the property. The valuer will consider the condition of the property, overall market conditions, and recent sales evidence to determine the value of a property. The value figure is expressed as a single figure and is presented on an industry endorsed template. If you're getting financed through a non-bank or a smaller bank, the short form valuation is the most common. A lot of those smaller banks don't actually do an AVM or an electronic valuation. It goes straight to the short form valuation. So be aware that potentially they need to arrange an inspection there too. So there's a 3, 4, 5 day lag time from when they start the valuation process to finish it.
Long form valuation. This is the most detailed type of valuation assessment that the bank can use.
This type of valuation is only used on complex, unique or high value properties. So if you're buying your first home, it's unlikely you're going to come across a long form valuation. But as with the short form, the property is physically inspected by a licensed valuer. Compared to a short form valuation, the long form is way more thorough and extensive. The type of valuation your bank is going to use really depends on the lender, how much deposit you have, the value of the property, even the location of the property. All valuations except for the contract of sale and AVM estimates are performed by an independent third party. In other words, they're not directly employed by the bank. They do this to try and avoid any conflict of interest. As I mentioned earlier, bank valuations can often be lower than market valuations. So why is that?
It comes down to the underlying goals of people doing the valuations. Market valuations are usually done by real estate agents, either on the buying side or the selling side. Their motivation is to get the highest price possible for the seller and to give the buyer a reasonable indication on how much they should spend on the property. Market valuations are typically assuming that the seller isn't in a rush to sell the property. In other words, that they're willing to wait longer. That means they're going to get a higher price. So overall, market valuations will tend towards a higher figure.
Bank valuations, on the other hand, have a different goal in mind. A bank valuation is all about limiting the risk for the lender. In other words, they want to make sure they can sell the property quickly and recoup any losses if they have to repossess and sell the house. And for that reason, it makes bank valuations a little bit more conservative. There are also a few other things that make a bank valuation tend to be a little bit lower than market valuations.
They're often more objective. They don't take emotion and the buyer sentiment into account. They assess the property as at the moment and in the condition it's currently in. In other words, they don't look at the potential of the property in the future.
They also assess the property in its current state. So if the house you're looking at is in a bit of disrepair or the quality, that there's holes in the walls, the presentation doesn't look great, the bank's valuer will factor this into their valuation.
So what's the potential impact of a low valuation? If the bank valuation comes in lower than the purchase price, it will affect the loan to value ratio. The loan to value ratio is calculated as a percentage of the loan amount compared to the value of the property. For example, if you bought a property for $1.22 million and you had a deposit of $244,000, you'd have a loan amount of $976,000. This translates to a loan to value ratio of 80%. So the loan amount to the value of the property is 80%.
Yeah, so the lenders use LVR to assess the risk of the property. Essentially, the higher the LVR, the higher the risk. If your LVR is above 80%, so you have less than 20% deposit, then you're going to need to pay lender's mortgage insurance or LMI in order to get your loan approved. And if your LVR goes above 95%, then, well, you might not be able to buy the property at all. So let's say the bank used an AVM to value the property at 28 Blackmore Street. That would give a valuation of $805,000. Assuming you had the same deposit Nathan mentioned before, the same loan amount would put your LVR at 121%. In other words, there's no way you get your loan approved without coming up with an extra $520,000 to bring your LVR down to a maximum of 95% if that was possible. Unfortunately, most people don't have a cool $500,000 sitting around, so there's a good chance that you wouldn't be able to go ahead with that purchase. And if you had bought this property at auction, which someone did, then you would not only lose the chance to buy the property, you'd also lose a lot of your hard-earned money.
Contracts of sale signed at auction are unconditional. As soon as you sign the contract, you're legally bound to buy the property at the purchase price. If you fail to do so, you'd lose your entire deposit, which is usually 5 to 10%, and you'd open yourself up to a potential lawsuit from the vendors for the lost sale. They can sue you for any losses incurred from the loss of the sale. This includes the real estate agent fees, listing fees, and importantly, any differences between the original contract price and the final sale price if they did have to resell it.
So if the property is sold for anything less than $1.22 million, next time they sell it, then you're liable for the difference. So in this example, you could lose $120,000 from the 10% deposit you put down on auction day, plus any differences between your contract price and the final sale price. So if the property resold for $805,000, then you'd be liable for an extra $415,000 in damages. Combined, you could lose over $530,000.
Buying a house through private treaty, meaning you put an offer instead of going to auction, is a bit more of a different story. You should be safe from most of the damages as long as you sign the contract to sell subject to finance.
In this case, the lender's going to do a bank valuation before your loan is unconditionally approved. So if the valuation is low, it's not a big deal if you can't move forward with the purchase. At most, you'd lose some of the holding deposit. In Queensland, for example, if you've got a contract subject to finance, if you terminate under the finance clause, you can get that deposit fully refunded.
It'd still be a sting to lose $3,000, but it's a sting that's a lot less than being on the hook for $500,000. So what happens if you get a low valuation? Are you completely screwed, or is there something you can do about it? The good news is that you do have a few options if you have a low bank valuation. Firstly, you can dispute the original valuation. You can provide the value with evidence of comparable sales in the area that you think would justify a higher price. They may be willing to adjust their valuation if you provide the right comparable sales within the last 3 months. It's worth a try, but most valuers are unlikely to change their original valuation. If this doesn't work, you can request a valuation from a different valuer.
You can do this by two ways. You can ask the lender to use another valuer on their panel to perform a valuation. In most cases, it's not going to be possible because if a bank holds two valuations, if they've got a lower one, they're going to go with the lower one, so it's not going to really prove any benefit. Otherwise, you can try a different bank, ask them to do a valuation of your property, and hope it doesn't go to the same valuer. Property valuations are pretty subjective. In other words, it's going to depend on the opinion of the person who's doing the valuation. So while there is a framework, there's no hard and fast rules to get to that end property value. It's what the valuer thinks the property's worth compared to this one that's sold down the street for $700,000, this one for $800,000, and how they compare. We've seen this with our clients. In one case, a client of ours requested a valuation from 3 different valuers, and the estimates vary by over $150,000.
This option has definitely saved plenty of people from getting into a sticky situation. If this doesn't work and you've made your offer subject to finance, you may be able to use these valuations to negotiate a lower purchase price from the seller.
If you bought at auction, then you're out of luck on this one. You've already committed to the buying of the property at the purchase price that you agreed at auction.
Finally, if all else fails, you might need to look at options to cover the shortfall.
You're gonna have to do this by increasing your deposit, maybe talk to a family member for a gift, or alternatively, in the example before, you might need to look at paying lender's mortgage insurance and increase the loan above 90%. you might still be able to get your loan approved as long as you satisfy the lender's LVR requirements. So summing it all up, hopefully understand more the difference between market valuations and bank valuations and all the different types of reports that we get. Putting it all together, here are the key takeaways. Firstly, market valuations and bank valuations are not the same. What the real estate agent thinks the property is worth and what the bank thinks it is not going to be the same. Secondly, low bank valuations can prevent you from getting your home loan application approved. If you're buying at auction, you want to make sure that you're very confident about the value of the property or cover any potential shortfalls if the valuation comes in too low. Otherwise, you may end up learning a very expensive lesson.
If you're buying by private treaty, always make sure you've got a finance clause in your contract to sale. And if your valuation is too low, all is not lost. You may be able to get a better valuation by asking a different bank to reassess the property and get a higher valuation as a result.
The example I used earlier might seem a little crazy, but could a bank value a property $400,000 less than the purchase price? But unfortunately, the answer is yes, it's definitely happening. While this case, the bank would not have used the AVM, they would have sent a value out there for the physical inspection. We've seen situations where a property bought for 1.4 million was only valued at 1.1 million. The shortfall in valuation for cheaper properties isn't usually that big. You're unlikely to get a $200,000 shortfall for a property that's sold for 500,000. But those valuations can still come in under purchase price and you need to be prepared for that. Make sure you do your research, look at realestate.com.au for recent sales, and get a really good feel on what sold, not 6 months ago, not 12 months ago, but in the last month or two in that local area on similar properties that have the same amount of bedrooms, that have the same block size, if it's a unit, have the same floor space, and get an understanding on what you're paying is pretty close to the market value.
So what's preventing you from qualifying for a home loan? Here at Hunter Galloway, we get home loans approved. So if you're living in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.